Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have Austin Hare. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Austin had a career spanning over a decade as a professional wakeboarder and more recently as an America Ninja Warrior finalist. Very cool. He got into real estate with a unique blend of discipline and calculated risk taking. Austin now shows others how to find locations that stack the deck in their favor and is focused on healthcare real estate backed by private equity groups. Thanks for joining us, Austin. Can you start by telling the listeners a little bit more about yourself and what you do?
Sure. Yeah, you skimmed over a little bit, but I was in wakeboarding for a long time. So essentially, I read the book Rich Dad Poor Dad, and then they were like, Robert Kiyosaki was saying you got to get a house and invest in real estate and get renters and stuff like that. And so that's just what I did. I was lucky that it was 2011 and it was the bottom of the market, so I got like a really great deal on a house. And I got like 4 roommates that wanted to wakeboard, and it was essentially a 4-bedroom house with a guest house. So 3 roommates and a guy renting the guest house. And I was getting paid to live in the master suite, with my own private deck over the lake, 2-story house with a pool and a hot tub, and it was great. So I was like, man, this is pretty cool. But I didn't really actually see the light at that time. It was more like this passive thing, right? Because he really talks about, make it passive income. And so of course, I worked my butt off, like remodeling that house and like fixing it up. It was always something, but it was quote unquote passive. So anyways, I opened up some fitness centers as I was retiring from wakeboarding, and as I was looking for new locations, that's when I met my partner now. And so, he did site selection analysis where we just looked at the competition and the demographics. And I had pinpointed in my head that I wanted to be in Winter Park, which is like a cool, kind of expensive area of Orlando. And I had thought to myself that I wanted to stay away from Kissimmee. But when he ran his analysis, it was the total opposite. Kissimmee was wide open. Winter Park was super expensive and super saturated. So I found out you can't make good decisions without good data. Luckily, I ended up selling the gyms in 2019. And that was simply because I got in a disagreement with the franchisor. Thankfully, he was making it very difficult to do business. And so I sold it right at the top of the market, right before COVID, dodged that bullet. And then my partner invited me to start working with him in commercial real estate. So now we do that process of site selection for healthcare groups. Think of dental, derm, vet, behavioral health, urgent care, sub 10,000 square feet, but multiple locations, and who are growing. They need an analysis. So we'll do the site analysis. We'll try and find out where to go. We broker the deal. And when it's available to buy or develop, then we'll purchase it and develop it on their behalf. And so one of the things that we've been doing recently is a little bit more of multi-tenant development. So we've just been facing issues with inflation costs, and like doing single tenant buildings have been really not conducive for pricing for our healthcare groups. So we do multi-tenant to help to lower the base. And in the short-term rental, in the residential space, I turned my houses that I bought from wakeboarding into short-term rentals, and a couple of them actually converted into wedding venues as well. So that's kind of where we're at now. And happy to go, whichever, there's a lot there. Happy to go whichever way you want.
Well, very, very interesting story. And pretty cool niche that you're in on the healthcare side. So what are some of the key data points you're looking for when you're trying to choose locations?
So there's a lot of different subscription sources that you can choose. We use one called Pitney Bowes. We just pay the subscription service for that. And then we just kind of do the analysis for free for our groups as long as we can broker for them. But really, I mean, you can pay anybody to do it if you want to. You don't have to use us, obviously. But like the process is essentially we look at all the data around the grocer anchors because they just have the best data. So you essentially will look at the ideal patient or the ideal client that the business wants to have. You match that up with the grocer anchor centers, and then you kind of tier it, right? So like for instance, in our world, if you're doing Medicare and Medicaid, a Walmart is going to be a tier one and a Whole Foods might be like a tier four. Like you might not need to go down to you don't need to pay the Whole Foods rent. But if you're doing PPO or private pay insurance, then you're going to be next to the Whole Foods or the Trader Joe's and stay away from the Walmarts. But either way, you create a tiering system, and then we kind of color coordinate those. So like tier one will be green, and then we'll have them all the way on down to tier four. We overlay those on the Google Earth map. We create a layer for that, so you can kind of get a visual of like where's these cluster of like greens, and then we do a competition analysis. So then we look for like, okay, what's your niche? What's your competition? Maybe you're a general practice dentist, or maybe you're an urgent care, or whatever. We've even done this for like we do this. We've worked with Starbucks and Chipotle and Panda and stuff like that on some deals. But like, where's the least amount of competition and the highest amount of patients already going to? And then we try and find places in that location. So, we're still looking at things like traffic counts, like street visibility. Are there trees blocking the view? Is it a right in, right out? Like, a lot of the what I guess you'd call basic types of indicators for retail real estate.
Very interesting. Have you tried this for like, let's say, multifamily or self-storage or some of these other asset classes?
No, we haven't done that. The reason being is like when my partner and I started working together in 2020 right when I sold the gyms, end of 2019, early 2020, and we kind of sat down and we were like, what asset class do we want to go into? And at the time, it was like, well, we know that healthcare is very recession resistant. Now it's like recession resistant, pandemic resistant, inflation resistant, and you didn't have as many developers going after those groups, even though the credit was great. So like according to the SBA, dental has one of the lowest default rates of all the businesses that they track. And it was a lot more competitive, like to try and get our foot in the door with like another retailer, call it like a 7-Eleven or a Starbucks or something like that. So we kind of took a roundabout way to do it, focusing. And then the other reason is just the square footage size. So like we hadn't done a deal that big, like a multi-storage or a self-storage unit is very big. A multifamily is like very big, so we were kind of trying to stay within our niche, if that makes sense.
Yeah, absolutely. I'm a big proponent of kind of staying in your lane. I see a lot of people in real estate. Um, if one asset class isn't doing good, they quickly jump into, a different asset class and or offer all these different options. And they haven't really built up like the data points and the skill set. They're just jumping in because something's not working right now. And there's something to be said about really, really focusing in. And I mean, Orlando's probably, Florida, it would be a great place to focus on what you're doing.
Yeah. Yeah, we do a lot in Florida. We do nationwide, but I would say Florida is our bread and butter, because we live here, so it's easier. But the process is actually kind of the same, like regardless of where you go. Like, we're using the only difference is like physically driving the locations, which we normally fly to a location anyways. But yeah, the fundamentals are all really the same. So, but to your point, Florida it has been pretty good. Like you saw some markets get oversaturated. So like, Texas grew like too much too quick after the pandemic. Even like Florida like certain markets are getting hit right now. But really the reason Florida is suffering, if you looked at a residential real estate chart, is because there's certain areas that just got hit by the hurricane like 2 years ago and even like earlier this year that like still haven't recovered. So it looks kind of bad on paper, but like there's still a lot of people moving into Florida, and the demographics are strong. So that does help it when you have a rising tide.
Yep, absolutely. So, besides all those checkpoints, are there other risk return ratio things that you're looking at to make investments safer?
Yeah, so we've been burned just by the school of hard knocks, right? Like you can't. I thought when I read Rich Dad Poor Dad and 4 Hour Work Week and the Entrepreneurial Myth that like that was it. I read these 3 books and like now I'm good to go. I can just retire at 22. But like with everything, there's a big learning curve to it. And so with doing like in terms of like to answer your question about risk return, I'll just give you an example of a project that we did back in 2020. We had an assignment for an urgent care and it was in Lease Summit and they've been looking for this place for like 2 years. And we finally found it was a Bank of America building that has been vacant and it was for sale. And the cost basis was like 1.1 million, which is a great deal for like a good retail strip center. And and so what we had to do was essentially line up two tenants because we had a lot of like extra vacancy. Like the urgent care wanted about half the space, and the other part was going to be vacant. So two things happened. Number one, the urgent care actually ended up like kind of pumping the brakes a little bit, and we kept pushing the seller, pushing the seller, pushing the seller. Eventually, the urgent care just backed out. But at the time, we had gotten Starbucks to express interest in giving us an LOI. So now we're in this kind of situation. It's like, okay, seller wants to sell, urgent care has backed out, and we don't have a signed lease from Starbucks. But the building is a great cost basis. Do we take the risk or not? And we had done the analysis, and it came back really strong. And all the analytics boxes were checked off. So we said, hey, let's just go for it. So sure enough, Starbucks did sign the lease, and we ended up getting a 90-unit urgent or what's it called, physical therapist who which had a really strong tenant, and so it ended up working like really really well. I mean, this was like a grand slam. Now, what happened was when they came back and the city was doing it wasn't the phase one study because we had already done that. The phase one environmental. I don't even think it was phase two. It was something else. But like they essentially came back and tested the parking lot and they said, "Oh, you got to totally redo this parking lot if you want to do a drive-through Starbucks." And we're like, "This is a drive-through Bank of America." Oh well, it's not up to code anymore. It being mind you, it was built in like 2000 and 4. It was only 15 years old and they had changed the code that much. So we had to drop $300,000 out of pocket. I think it was 320 grand. We had to come out of pocket collectively between the partners um, in order to resurface the parking lot. And so even with that happening, like we got it at such a good cost basis, even after the build out cost for the new tenants and then doing this, like we're still averaging like pretty like high teen IRRs. But like that was one of the things, we learned a lot. It's like you got to make sure you're doing your due diligence process ahead of time so you can calculate that for that because that would have added to the project cost, which would have added to the loan value, which would have meant we could have raised like more initially, but less overall. So those are just the things that you learn from doing.
Yeah, I'm shocked. How can a drive-through, change from a bank to a Starbucks? It doesn't make any sense. But I know these communities have these kind of wonky laws, and the use of it is very particular.
Yeah. And I think another point about that I'll make about what you're asking about risk return profiles. That's actually a lot of like what we focus on. What we're doing right now is focusing on the multi-tenant. So like kind of like the example that I gave you, but there's a small period of time where these dentists and these healthcare groups wanted single freestanding buildings because they could afford them. I mean, I think everybody would argue they want a freestanding building because essentially you get three corners of marketing, right? Like you get everybody driving by each way will see all three sides of it. But you just have the least economies of scale. So a lot of developers don't like doing multi-tenant because it's riskier. Now, instead of finding one tenant, I have to find two. So when you get an assignment to do a development for a tenant, it's very risk averse. Like, hey, I can build up the building here. Boom, they'll come. But in our case, the cost of labor and capital and interest rates and real estate is just so high. Like we're pricing those guys out of the ability to be able to do single tenant. And so what we're doing is we're taking on the risk as developers because we've been building relationships for such a long time. Like we've done other deals. We use healthcare as a way to get in or get our foot in the door with these other retail tenants. And now when we get an assignment from a retail tenant, we can bring in some of these other retailers that pay a little bit more rent. We can keep the healthcare rent a little bit lower and the investors still make a good return. So that's one of the ways that like we're de-risking it. We're de-risking it for the healthcare group. So they like that. They can pay lower risk. But then because we have like existing relationships of deals we've done with other retailers, that allows us to de-risk that multi-tenant development part because we can kind of soft pitch that ahead of time. And so again, like I'm not saying that, you have to go work with us. Like anybody can do these strategies. This is just a little peek behind the curtain at how we do it.
Right, right. Nice. So talk to me about the pros and cons of medical retail. I mean, we just went in through it a little bit, but are there other pros and cons that you're looking
Yeah.
at?
So it's interesting because you're in this asset class that is growing. The patient base is growing. The patient demand is growing. which is great. I mean, we've gone from 350 billion in annual spending as a country to like 2.2 trillion since like 1987. So it's like above the inflation rate, and it's only going to get more and more because baby boomers are retiring, and they're going to need increased costs of healthcare to keep them alive longer. And that's just kind of the future for better or for worse. But here's the caveat. They are capped by either regulation or insurance reimbursements as to how much they can charge the patients. So you have an inflationary environment. And look, there's a lot of waste, and we can talk about hospitals because like they do a lot of shady stuff that I don't agree with. But like in our niche, it's like these smaller groups um, that aren't really facing a lot of those like we're not talking about the ambulatory $10,000 charges for whatever. These are just like your urgent cares and your dentist and your dermatologist, and like you kind of you pay for what you get, right? Like you know what you're going to pay going in to an extent, but the reimbursement rates are capped because the insurance companies like only will pay a certain amount, and even in an inflationary environment, they're lowering the amount of the reimbursement. So you just have a tricky situation where a lot of these groups are getting squeezed because Medicaid and government reimbursements and insurance reimbursements are lowering, but their costs are going up. So that's kind of like the downside. But like we talked about a second ago, if you can build a multi-tenant development, then you can help offset that. Now we've tried looking for second generation spaces, but we're talking about an industry where the patient demand is growing. There's just not a whole lot of second generation spaces. So it kind of brings us back to, doing multi-tenant developments as a way to kind of counteract these problems that we're running into.
Yeah, and then the disincentive nature of healthcare, which has to change at some point because the costs are just insane.
Yeah.
It's just going to the spending and the need for more and more facilities just keeps going up.
Yeah, I mean, look, I'm as excited about as any. Well, I don't know. I don't know if anybody else is excited. I'm excited about the Doge, the Department of Government Efficiency. I'm really excited for them to do a lot of cutbacks. We got to cut all the spending, all the excess spending, and it manifests its way through healthcare. But largely, it's like the hospital systems. It's like those hospital systems that are really have a lot of bloat, and I don't, the medical benefit intermediaries, MBHs, whatever they're called, like all that kind of stuff drives prices. But we don't really actually get affected too much by that in our space. Like we're dealing with a lot of these smaller groups. Sometimes the urgent cares that we work with are hospital backed, but sometimes they're just private equity backed. So we don't really have to deal with a lot of that bloat. So like, I think even if I think first of all, yes, spending does need to decrease, but even if it does decrease, like per charge or per appointment, like overall, like the frequency and the amount of healthcare needs that people have as they age, it's only going to increase. So like in that sense, like we're pretty convinced that it's just a very durable asset class to be in. And it's like we're talking about risk and reward. It's just a very low default rate, right? Because there's always such a need for it. I mean, people were really worried about retail for a long time, like during the pandemic. And people were saying, oh, retail was going to die. People aren't going to go into the store anymore, blah, blah, blah. And like you can have some of those concerns. Now that ended up being wrong because retail did fine. It was like other industries like office and some multifamily that really got hurt. But to the same extent, like you're never going to be able to virtually do all of your healthcare needs. You're just always like that. It's your body, right? Like as long as you have a body, you're gonna have to go in somewhere. So that kind of keeps us like pretty optimistic, like pretty bullish on the risk reward thing. So look, there's some deals that we see that are like in the high 20, 30, like 30% IRRs. That's not really us, right? Like we're going safe, we're going risk adjusted. Like that's kind of what we're going for. And you can, for everybody listening, like you can decide that risk based on the credit of your tenant, like you can figure that out. So if you're trying to develop your own deals, or you're looking to invest in deals, like you can see the credit worthiness of those tenants by like asking for their financials if they're not a publicly traded company, and then that should absolutely affect your willingness to work with them or even the rent that you want to get them to pay.
Are there any particular markets that you love for the medical field that you feel like, again, supply and demand, and anything else that what are you seeing for 2025?
Yeah, I think that Florida, the fundamentals are still strong. Like, we're here. I mean, we're doing a deal out in Oregon right now. That one is looking so yeah, it's hard to say. It's all got a pro and con, right? Like we had to submit a 200-page document to the city to do that, to get approval for that deal. And so as a result,
In Portland.
and yeah, right outside of Portland. Yep.
Yeah,
Yeah, that was
that makes
crazy.
sense.
Yeah, exactly. But as a result, there's not as much new development going on there, right? So like because we went through the headache, now it's looking like that'll be a really strong return. So yeah, I think geographically, like everywhere kind of has like its pros and cons. I mean, we try and stay away from like the really saturated metros, like meaning like New York City and LA and like downtown Chicago, places like that. Like and the cap rates, the rents are really high, cap rates are really low, prices are crazy. It's really hard for healthcare like to kind of make that work and for us as investors to kind of underwrite that. So I would say like that's kind of like our least exciting area. But like otherwise, like I mean, it's feeling pretty bullish for 2025. Like, people are originating new deals now that the election is in the rearview mirror. We have more clarity. Yeah, I think like that. I think that there's a lot of investors that are looking to get involved with deals, and there's a lot of groups that are looking to grow. So I'm feeling pretty good in general about the the United States geographically.
Absolutely. And yeah, I fully believe, yeah, there's opportunity everywhere, even if there's a place with a ton of red tape, um, and barriers to entry, that just means for the ones that are willing to put in the work and really understand the laws and navigate all that, there's some opportunity as well. So it really depends on your thesis of how you want to invest.
Yeah, exactly. I mean, there's definitely something for like staying in your lane, right? Like I wouldn't necessarily like go to a place that was really hard to do business just because it was hard to do business. Like we had a client giving us an assignment there, in Oregon, which is what kicked off that whole process.
Well, Austin, I appreciate you coming on the show and really providing a wealth of knowledge on uh, medical retail space. Where can listeners find out more about you and your company?
Yeah, so I'm pretty active on LinkedIn. It's just Austin, like the city, hair like on your head. Yeah, if you reach out and try and get in touch there, that'd be great.
All right, awesome. Thank you, Austin. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.